Recent history has been very disruptive in the U.S. real estate markets. We've had the combined effects of geopolitical uncertainty and supply chain disruptions, which have been the catalyst for rising inflation and higher borrowing rates, which has had a very direct impact on the capitalization for direct property acquisitions in the U.S. because senior borrowing rates are a lot more complicated, difficult, and higher. So what's that led to is higher property yields being required, higher returns, and lower valuations. But the real problem has been focused on the lending side, where the credit lenders are increasingly pulling back, which has led to a more difficult time getting financing for acquisitions. For example, the banks have been pulled back by higher deposit rates. Securitization lenders have been pulled back by difficulty in executing in the capital markets, and those who require financial leverage like CLOs have also been constrained. So from year to date, that's resulted in higher returns for commercial real estate lending, but also lower risk. So for example, year to date, we've seen increases of about 400 basis points on where we can lend today versus where we could lend at the beginning of the year. You break that into the attribution, about 230 basis points of that is coming from higher benchmark rates, about 130 basis points is coming from increased spread premium, and about 30 basis points is coming from forward curve changes. So as a company, we're stepping into that gap and bridging the gap of the void there. So on the whole loan side, we can now make whole loans that are more like 6.5+% returns. On the mezzanine side, we can take loans at lower attachment points with thicker capital structure pieces and more control and get double-digit returns. On the preferred equity side, we can step into a void where loans are lower leverage and property owners cannot find the gap between 60-65% leverage and 80%. So that means, as a firm, our opinion is, we're looking for this opportunity to step in the middle and to be a bridge to the gap for financing that's out there. So we're stepping in now and making loans on primarily like defensive sectors where there's a supply-demand imbalance. I would use the example of industrial, multifamily, self-storage, and in some cases targeted office properties where you have Class A and less of a risk of work from home trends.